Hello, real estate mindset community, and welcome to another morning live. Happy Monday. I find Mondays are so hard for me because I have so many thoughts. There's so much that I want to say. It's hard to get my thoughts together. We have a lot of stuff going on in the market. You got it right, Navy Blue. Good call, sir. Really nice to see everyone. Hope everyone had a great weekend today. Again, a lot of stuff. I'm going to go right into our market update. And where I want to start is by talking about the National Association of Realtors. There is so much going on right now with the National Association of Realtors. And if you guys don't know already, basically, if you're a realtor and you want to have access to MLS, you have to basically be a member of the National Association of Realtors. NAR is like the huge, giant association. So when there are things that are happening at NAR, it's worth paying attention to because more than likely with all of the lawsuits, there's going to be permanent changes in the real estate industry. Specifically, what I believe is going to change is the requirement for the seller to pay for the buyer's agent. So I think that's going to be done. We're going to go into what is happening right now with NAR, but I wanted to tell you before I jumped into this article, it will be referenced in my description. If you guys want to listen to a really good video, Todd Sachs at Sachs Realty put out a video. I think it was on Saturday. He put out the video on Saturday with John Williams, and he went into what the National Association of Realtors is actually doing. And in the video, some of the takeaways that I got from that, again, this is Sachs Realty, was basically it seems like the National Association of Realtors are training the realtors to be replaceable, and they're even investing in fractional ownership. So, in REITs and just all kinds of stuff like that. So there's huge things going on out at NAR, but I'm going to start my timestamp right now and we'll get started, you guys. We're going to go into this article right here, okay? That's not the article. That's the article. I'm so sorry, guys. It's Monday. I'm a little bit slow right now. Anyways, so this just came out this morning. You guys can see this right here, October 2nd. I'm tired because I woke up so early. But anyways, this is Redfin basically telling us why. Hold on one second, guys. I'm so sorry. This is Redfin telling us why they're leaving the National Association of Realtors. So Redfin is leaving NAR. Do you guys hear what I'm saying? So this was published by Glenn Kelman. This is humongous news. I cannot believe this, to be honest with you. This is huge. Again, this came out this morning. Now, Redfin is basically telling us there's two reasons why they're basically leaving the National Association of Realtors. The first one, I don't buy it for a second. I think that this is just what they're saying. But the first reason is NAR policies require a fee for the buyer's agent on every listing. So in order to list a property on MLS, you have to put a fee for the buyer's agent. That's why when Lennar started cutting agent commissions, in order for Lennar to list some of their new homes on MLS, they had to show $1 for realtor commissions. So very, very interesting. That's a requirement. Now, the second thing, and this is really, really mind-blowing and actually depressing, a pattern, literally multiple, and I did two videos, one on RE/MAX settlement and another video on what's going on exactly at NAR. With these sexual harassment allegations, but there's a massive amount of sexual harassment going on. So they're going into this a little bit more, pattern of sexual harassment. So without getting into much of the sexual harassment stuff, because I really want to stay on real estate, not that sexual harassment is not like super really important. But that's one thing. I'm really interested on how they're going to continue to make offers, right? How they're going to continue to give us data if they don't have access to the multiple listing service. So this is what this says, resigning from the NAR board. Redfin has already resigned our national board seat in June. So they not on the board. So they're still using them, but just not on the board. And that was before the sexual harassments came to light. In the many markets governed by its policies, NAR still blocks, okay? NAR, National Association, you guys probably didn't know this. NAR, not only are they fractional investing and killing realtors, by the way, NAR still blocks sellers from listing homes that don't pay commission to the not seller's agent, the buyer's agent. It is, when I really read that is kind of crazy, right? Like they're forcing a seller to pay the buyer's agent. Holy smokes. And it blocks websites like Redfin from showing for sale by owner listings alongside agent listing homes. Did y'all hear that? Because Redfin is a part of the National Association of Realtors, they are not allowed, listen to what I'm saying, they are not allowed to show for sale by owner. They're not allowed. because of NAR. What right does NAR have to say that, you guys? And one thing that I really like about Todd, let me just say this real quick. Todd's point is, because guys, I'm hard on realtors. The reason I'm hard on realtors is because I need to be, because if I'm hard on realtors, it helps everyone. It helps the consumer. It helps realtors to step up, right? But Todd's thing, and he has great points here, is the problem with the real estate industry is at the top, right? It's at the top. So, I mean, we're seeing that really, really play out here with the National Association of Realtors because they're at the top. But he's got good points there. Okay, now look at this, guys. This is insane right here. So Redfin will require many of their agents to resign from the National Association of Realtors. Is that not insane to you? So the next paragraph here, NAR has forced an all or nothing choice on us. But this all or nothing approach isn't of Redfin's choosing. NAR rules require us to leave local and state associations when our only beef is with the National Association of Realtors. So they're saying, you got beef with us, we're going to kick you out from all the state agencies because we run them, homie. Dude, I'm telling you guys, the NAR is like the mobs. Like the more that I read about the National Association of Realtors and like the campaign donations, you guys, the more that I'm like, man, this is a mob type agency. I mean, they're running it like the mob. I have a video later for that. The rules require that for a broker to be a member, she must pay dues for each of their agents under their supervision, regardless of whether the agent is a member. Okay. So if someone's under a broker and they're not even a member of the National Association of Realtors, the broker still has to pay. Y'all, they got a monopoly on real estate. It's insane. The rules further say that if a broker isn't a member, no agent under her supervision can be a member. So now they're like, dude, we don't want to be your member. MLS is a joke. We all know it's a joke, as is the National Association of Realtors, and homes normally sell themselves. And that's a fact, you guys. But there are some great agents. It's just there's very, very few and far between. And check this out. They can't completely leave the National Association of Realtors because in some states, and you'll see that right here, in some states, in order to even write a contract, you guys, in order to even write a contract, you have to be a member of the National Association of Realtors. How is that fair? How is that fair? That's interesting. But in many markets, we can't even do that. But often we don't have that choice. In about half of the US, including cities like Charlotte, Dallas, Houston, Las Vegas, blah, 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 Salt Lake City, we cannot quit NAR individually or en masse because NAR membership is required for agents to access listing databases and lockboxes and industry standard contracts. It is impossible to be an agent. Again, it is impossible to be an agent if you can't see which homes are for sale or unlock the door to those homes or even write an offer. So that's pretty big deal, right? That's a huge deal. So this is crazy to me, guys, because I really feel like it's going to be a domino effect. I think that's going to pave the way for like more probably Zillow to do it. And I'm really curious to see if someone makes another type of MLS or multiple listing service, because honestly, it's needed. And why wouldn't we do it? I mean, the MLS is like a 1990s, 1980s system. I mean, it's 2020. We're in the 2020s right now. Look at the AI that we have. I think we need to make a public MLS. And if people want to sell their house by owner, sell their house by owner. My only concern is the legalities of those purchase contracts are super rough and really, really important. So that's my only concern with that. But, obviously the public needs more access, so we're not at the mercy of the realtors. Now we're going to jump into the 10-year right now. Let's look at the market. Let me put you guys on this right now to take a look at this, guys. This is mega right here. So we're at a new record. I don't know if you guys, it's hard to keep up with this 10-year because this sucker's all over the place. I mean, this is like, hey, recession's gonna be here soon and things are gonna start to break. Basically, we're at 4.64. And I wanted to let you guys know, we haven't closed yet, but the last high for closing was 4.61. And that was on September 27th. So about a little less than a week ago was our last high. So we have exceeded that as long as we close. In other words, you guys, that 10-year is skyrocketing like crazy. It's crippling REITs, institutional investors, long-term rental market, depending on when you purchased and your setup, of course. But this is absolutely killing the industry right now, you guys. So we're sitting at 4.64. Look at the movement on interest rates. This was a surprise to me. The interest rates plummeted on Friday. 16 basis points, and there's not a huge reason why as far as following the 10-year. The 10-year did go down, but it did not go down that much to justify 16 basis points. So I think what we're going to see today is we're going to see it right back up. It's probably going to be over, I don't know, probably, what do you guys think? Comment below what you think. I think we're going to be at like 7.55 or something like that when it updates today, but this is not reflecting the entire 10-year right here, or the long end of those yields. I just want to let you guys know that. But we are sitting at 7.44%. Let me show you what effect that has on a house payment. And we'll go through this quickly. You guys should be getting used to this right now. Part of the education of my channel is basically making you guys aware of amortization schedules. Now, this only applies when you've already owned a house, but it's important to understand how awful amortization schedules are. When I put the average loan amount right here, this is what I do: put the average loan amount, and then I put the daily average interest rate, so we can see that the payment, which is taxes and the payment without taxes and insurance is $22.79. Now look at the total amount in fees you would pay on a 30-year loan. If you paid it for 30 years, if you don't pay it for 30 years, it's not this amount. And if you refinance, it could be even more, because refinance, you start over. But right now, if you guys buy the average home, get the average loan, you're going to be paying $492,000 in interest. Now, one thing I like to point out is how much of a big dent we can put in our amortization schedule if we pay down the principal in the beginning. The later on in the amortization schedule that we start putting more money towards principal, the less impact it has. So it's really super important you pay the amortization schedule down immediately. And basically what we can see here, now remember, you guys, higher the interest rate, the more the savings. Higher the rate, the more the savings. So what we're at right now is basically, and remember, we started at about $20,000 to pay it down to 5 years. So in order to pay your amortization schedule down to 5 years, after you close, remember what I'm saying, the amortization doesn't start until you close, right? So after you close, you would need to pay off 5 years only $17,841. You would be saving all 5 tiers of interest right here, which would total $118,955 in savings if you were to finish paying off that loan. So it's a substantial amount. And I also wanted to point out that you get that money back, right? When you sell, again, once the market rebounds, right? Obviously, we're really, really worried about negative equity and price decline. So in a negative equity and price decline situation, it wouldn't be applicable. But in a normal market, you get that money back because all you're doing is paying your loan down. And the same thing with a down payment. So it's not like you're wasting your money. Do you see what I'm saying? It's still there for you. That's the point I was trying to make. Let's move on to the how much can I afford calculator. So let's see here. Okay, so we're going to see how much now. We're going to move on to the $100,000 affordability. Okay, so part of the segment on the channel is if you make $100,000 and you have the average amount of debt, what can you qualify for? So remember, the average consumer, as shocking as this sounds, has roughly $1,400 in monthly debt payments. Okay, so if we look at that, $100,000, remember 18% down payment, $500 HOA, 45% I changed. Debt to income ratio, I'm going to calculate that. Look at this, guys. So the average person that makes $100,000 and the average amount of debt, okay, only qualifies for $299,463. Now, if you make $100,000 and you have no debt, you have no consumer debt, instead of $299,000, you qualify for now $481,087. That is a difference of, you guys ready? $181,000 in purchasing power. 181 grand if you don't have debt. So again, that's how important it is not to be in consumer debt, because in order to qualify for the loan, the debt to income ratio calculates monthly payments, not the balances. It calculates the monthly payments. So the more monthly payments you have, the less you qualify for. And I really hope that's eye-opening. Again, the average person in America, because they're in debt, loses roughly $181,000 in purchasing power. So the next time you go to a department store and you see a credit card and you get 10% off your purchase, understand it's horrible. Don't do it. Just don't do it. Just don't do it. Okay. Get out of consumer credit card debt. Let's move on. Now, this one I've been watching. We need to keep our eyes on this. I hope you guys are sticking with me here on the 10-year and the 2-year inversion. This is insanity. We're witnessing like really, really important, like historical things right in front of. It's not history yet, But when we look back at, maybe 10, 15 years from now, we're going to be like, holy smokes. And we are covering this live right now. Okay. This is the live chart right now. This is reinverting right before our eyes, you guys. So this is the 2 and the 10. This is the economic indicator of recession. When we talk about where do we get the inventory from? Where would the forced selling come from? Well, there's going to be many things that we point out. One thing that I don't point out too much is consumers that are struggling, right? And what do I mean by struggling? You lose your job. Let's just say it. Okay. Unemployment is not unhinged yet. And that's really what we're saying. When we get inventory and forced sellings from existing homes for consumers, it's going to be a recession that does that. It's going to be job loss that does that. And right now, what we look for here in this chart is reinversion. Okay, let me max this out. Because generally we reinvert and then we go into recession. Reinversion means above the black line. Right now we're below the black line, okay? But again, look at the trajectory here, you guys. Look at this trajectory. I mean, this sucker, oh my gosh. And you know what's crazy? It's going to do the same thing today when it updates. I think this updates, 4 p.m. or like 4:01 p.m. Eastern time. Y'all, with this 10 years shooting up like this, 6 basis points, okay, where depending on what it closes, if it closes with 6 basis points up, this is right here, where we at right here, this is going to continue to shoot up. We may be reinverted by this month. I mean, we really might be reinverted this month. And then again, remember, we reinvert and then we go into recession, usually, except in the 70s and 80s. That's very, very interesting to me. I don't know if you guys find that very, very interesting. So what we're going to do now is we're going to go into our first video. This is an intriguing, I got some good stuff for you lined up. Don't worry. This first video, I really feel like it's super important. This is going to go into, because there's a lot of people, and we'll cover this later on in this video, that are like, oh, how's the market going to crash? Right? Oh, there's cricket. How's the market going to crash? Okay. So, and I have all of those answers, by the way, but I see like when they ask people that don't have those answers, it's so frustrating to me. But this is going to be good because one of the bullish arguments is the prices are going to be sustained because there's not enough inventory. And obviously I just did the STR video last night and we have inventory coming from multiple places. But the thing is, guys, the only alternative that I can see to not having prices correct, we'll just say correct, we don't want to offend anyone, is wage growth. We have to have we have to be able to afford it, right? We have to be able to afford it. The consumers too. And we look at the 70s and 80s, and we'll go back and we'll look at this later on in the video. But the thing is, guys, we're not making enough money. Right? We're making less money than the rate of inflation. So we're making less money. It's inverted. We're making less money because inflation is going up. We're not keeping pace with inflation. So this next video is basically going to be on the fact that it's really, really good. Now, I'm prepping you on this video because this dude is so boring, you guys. I mean, he's just, there's no energy in his voice, but this guy is brilliant. I want you to pay attention to this video because it's really going to dig in to what is going on in the economy, and that impacts us as consumers, and it impacts, because it impacts us as consumers, it impacts the housing market. So I hope you guys like this. Please let me know that the audio is okay.
Trying to follow the Fed. People see different things. We had a economist who's really smart and really good on earlier, Kelsey Barrow, said inflation's been coming down faster than the Fed thinks. Right. That's going to continue. Oil prices up where they are can be deflationary because it causes people to realize, oh my God, I just filled my tank. I don't have anything left over. Shelter's coming down. We've gone from 300,000 jobs a month to 150,000. Last rate hike is in, it's done, and they will cut probably next year. You probably don't agree with any of that, do you?
No, I mean, it's a reasonable scenario. I'm just not sure it's very likely.
Well, what does she see? What do you see that makes you think differently?
We have a lot of still enormous fiscal stimulus in the economy. That's a plus and a minus. The minus is it runs up the carrying cost. You know, Joe, the last 11 months, we've been incurring $644 billion in debt payments, interest payments. Defense budget, $692 billion. This is growing. We have $33 trillion in federal debt now. So why don't you, simple math, if you say the average cost to carry is going to be 5% between the short and the 10-year, you can do the math. That's a lot of interest being carried. So the stimulus comes from that. The problem is, and it's inflationary in many ways, pumps up the economy. but we're spending a fortune on interest, $2 billion a day on interest. The good thing is we're in better shape than everybody else. So money's still coming into the United States. If you look at the DXY, which is heavily euro oriented, it's trading at 105. That's still a strong dollar. So there's some very attractive things about what we are doing, even though we're running up these huge deficits. We have an irresponsible fiscal policy, Congress that is dysfunctional, et cetera, et cetera. We're still the best place to be. Of course, within the United States, Texas is the best place to be.
Let's go.
But we won't talk about that.
Let's go, Texas.
I see these crazy polls that say Texas is dead last because of, I don't know. It depends on what questions you put in the polls.
Well, I can tell you, the Dallas Fed just released some data.
You don't educate your kids or something? You don't spend any money? You've heard all the...
Well, nobody educates their kids anymore.
we have Randy Weingarten on it. I don't know what to ask her.
But at every single
Is any of the criticism
category,
warranted for teachers unions, Andrew? Can we ask her that? I mean, why is there so much animus directed at teachers unions, and why are our kids? Can we ask her that, or I don't know.
I think we can absolutely ask her that, and I think the answer is that the results don't. Unfortunately, the result it's very result oriented, and you can see those results.
And they're not.
And by the way, and they're not good. On the other end, I think one of the reasons we're having her on is to talk about the movement towards labor in this country,
That is why,
and what you're looking at with the UAW. By the way, the UAW. Their results, you can look at the results. They come out quarterly. It's very clear what the results of their work is. So
we're still playing catch up, Joe, to the fact that people are earning less than the inflation rate. And now they're making up for that in spades.
Which adds to the inflation rate.
It's not just which adds to the inflation rate. It's not just the union. They're only 10% of our workers in America are unionized.
Is that back to 10? I thought it was 7 or
7% in the private sector.
Private sector. Okay.
So, but we're seeing it in small, medium-sized, but look at the NFIB data and the surveys. They're still feeling that kind of pressure. And they're having trouble finding skilled workers. That's where the economy
So then
really
you see the inflation. Okay, so they're not going to be happy till there is a recession. Will there be a recession next year?
This is the most long predicted recession.
I know. No, now it's off the table, which means it's back on the table. Now people aren't expecting.
I think you have to give Powell and the Fed credit here.
Yeah.
They made a mistake on the transitory inflation argument.
Okay.
They've corrected for that. The economy has not tanked. Everybody keeps saying it's going to tank, going to tank, going to tank. And inflation is coming down. The core rate is still high.
Inflation, maybe it was transitory. That's why it came down. Or did it come down because of what the Fed did?
It's only transitory because of the Fed.
Well, it depends on what your definition of your time frame is. Everything's transitory.
You and I are transitory.
Life is transitory.
Right.
I'm transitory. I won't be here forever.
Right.
Unfortunately for you guys, but anyway.
Yeah, unfortunately.
But one other thing, Steve was mentioning Fed funds futures. They've never been right. Ever. So we spend a lot of time talking about Fed funds futures. It's never a good predictive mechanism.
what do you think is?
Except for just before a meeting, maybe.
Right. What is?
I think you have to look, if you remember, I'm a Texan, so you put a gun to my head, I would say you have to look at the employment data.
Okay, good.
That's the number, if I had to pick one variable.
Are you looking at the, when you say employment data, are you looking at the unemployment number? Are you looking at wages?
Well,
are you looking at a combination
the
of
dynamics, the quit ratio and everything else in between? But
and what
if
would
you have
you
a
say,
job, you consume.
Right.
If
And what would you
consume,
say
drive the
those
US
things
economy.
portend right now?
Right now, we're in pretty healthy shape. People are still holding on. Big companies are laying people off. But if you look at, again, the small, medium-sized companies, the women and men that actually build our economy and create jobs, they're still holding on to their employees. You know, why? Because demand is.
Well, you guys, corporate bankruptcies are skyrocketing, as is the unemployment rate. I think he has some good points there. And I also appreciate him talking about unemployment. I think that's a huge factor, unemployment. It looks like the Dixie is up right now to 106.78. That's why BRICS, I don't think is going to work, you guys, because who's going to replace the dollar? But anyways, let's move on now. Obviously, some good stuff there. I don't know how, well you agree with him or not, but let me show you. Okay, let me show you what's happening in the reverse repo market, because on one hand, there's a lot of people, except the Federal Reserve, there's a lot of people saying inflation battle's done and that the economy is in good shape, soft landing's coming. and there's no more rate hikes. Okay. But when we follow the money, it's a little bit easier to see through people's biasness. And one of the things I like to follow as far as watching the money is the reverse repo market. Now, if my impression is basically if the market thinks that there's going to be no more rate hikes and there'll be rate cuts coming, that the money is going to flood out of the overnight reverse repo market, because that's the short end of the treasuries, and they're going to go into the long end of the treasuries to secure the high yields, the 5% yield, or whatever. So take a look at what's going on in that market. Again, this is the 1-day treasury. Look at this, guys. It shot up. Literally on Friday, skyrocketed up. So on one hand, well, first of all, it's consumers. A lot of consumers are feeling the pain. Corporations are feeling the pain. Realtors, loan officers, commercial real estate. A lot of people are feeling this. I'm feeling the pain. I don't know if you're feeling the pain, but look at this, guys. It shot up. So it started plummeting, and boom, it shot up. And to me, again, this tells me that inflation and the harm of inflation is still present. Now, here's the 5-year break-even inflation rate. When the Federal Reserve talks about inflation not becoming unhinged and like a panic ensuing and things, they're really looking at this 5-year break-even inflation. And I wanted to point out that it's basically been, it went up at the end of August. You guys can see that. It started going down, and then it went back up, and then it's kind of went down again. So just keep your eye on that. What the Fed's going to want to see is they're going to want to see this at under 2%. It's at 2.22 right now. So keep your eye on that. And also what I think is really, really interesting, you guys, I did a video, one of my live videos, and y'all heard Ramsey say, just buy a house right now if you can. If you can afford it, okay, I understand if you can afford it. There's some validity there depending on your situation. If you can afford it, buy a house, right? But there's many other things I would add to that. But he also said, this is Dave Ramsey, and I don't want to knock him. He's helped people. He's helped people get out of debt, okay? I'll acknowledge that. Credit card debt, like consumer debt. But the thing is he said, we don't know if interest rates are going to go down, but we know prices are going to go up. Again, Ramsey said, we don't know if interest rates are going to go down. We know that prices are going to go up. But that's not true. We actually do know interest rates are going to go down. The question is when, right? And how do we know that interest rates are going to go down? Because the Federal Reserve tells us through that dot plot, okay? They're basically saying, here's where rates are going to be. Here's where rates are going to be this year. Here's where it's going to be in this quarter, right? So they're telling us that rates are going to go down. And honestly, we see that in CME Fed Watch, okay? I just wanted to give you guys a quick breakdown on CME Fed Watch. The market's basically writing off a second rate hike in November, 30% chance. But look at December. December, we're sitting at basically a 50-50. Oh, it went down, actually. A little less than 50-50 for a rate hike in December. So not a full pricing in on the rate hike, but take a look when we get further into the year. You guys know that I'm looking at June and July. Because in order to break seasonality, buying seasonality, we need demand to be crushed in the beginning of buying seasonality, right? Which is basically what? March. So the fact when I click here and I go to June gives us when all is said and done, roughly 60% likelihood that we're going to have elevated rates. So 60% likelihood in June. But what I really love, y'all, is the market's now pricing in a 39% likelihood that we will have elevated rates. But the beautiful thing is they're also saying that even if we don't have elevated rates in July, that there's like probably, let me calculate this in my head real quick, like an 75% chance that even if rates are cut, it's only we cut by a quarter basis point. That's it. So even if rates do start going down in July, it's barely at all. When they are going to really start going down, according to the Fed, will be in 2015. So 2015, depending on their inflationary battle. I thought you guys would think that would be pretty interesting. That's really good news because we don't want to lower rates too soon. Now, what I want to do is let's go into our next video. Now, our next video is going to be from a realtor, and they're being interviewed. That's going to go into the San Jose market, and they're going to talk about how it's a seller's market. And what I want you to, and after this video, we're going to go into Redfin data, and I'm going to show you guys the months of supply. I'll show you guys the price cuts. I'll show you guys where we're at. But what I want you to focus on is the realtor that's talking. And I want you guys to tell me whether or not you feel that they're confident or not confident, or whether or not you think that they're right or not right. And again, what I'm saying is realtors, and this is why I'm so hard on them and I talk a little bit of crap. they're freaking so important. They really are. The realtors are so important to our community, to be honest, and have transparency and integrity, because they're the only ones that have access to MLS. Half of them are the only ones that you can't write contracts half the time on your own. It's just, they're so important, but there's just so many that are trash. There's just so many, and I need you guys to understand the difference. So they're definitely playing narratives. Let me know that this audio is okay. We're going to go into our next video right here. Enjoy.
Welcome back. It's the final day of our Powerhouse road trip, getting an in-depth look at what's happening in different housing markets around the country, including and especially these days, just how far $1 million budget really goes. Yesterday, we were in Albuquerque. $1 million goes pretty far there. Today, we're heading out to San Jose, where not so much. It's number 37 of the top 100 metro areas by size. And, you know, our hitchhiker Dom Chu is along for the ride. Prices are up more than 5%, nearly 5% from last year, with a median home price of nearly $1.5 million, according to Zillow. Here to tell us more is Anna Fine of Coldwell Banker. Anna, it's good to have you here. Welcome.
Hi, Kelly. Thank you for having me.
My understanding, correct me if I'm wrong, was that the market out there actually had a tougher maybe 2022, but has since rebounded or firmed up somewhat. Is that right? Or has it been strong all along?
That is correct. We had a little bit of a downturn end of 2022 as the rates continue to rise. But starting this year, it seems like we're back where we were. And it looks like buyers just got used to the new rate. And we are back at super competitive market and a strong seller's market.
So now, okay, let's talk about the strong seller. So $1.5 million and an 8% mortgage equals what per month exactly? How are people really financing or affording these homes?
So I have to mention that our market is unique in many aspects, but one of the unique aspects of our buyers here is that they are highly stimulated by the stock market. So if stock market is performing well, we have more buyers and they are able to afford high monthly payments. So primarily we do see people put 20% or more towards down payment. We do see a lot of cash buyers as well. So people can still afford. I guess most of the buyers are in tech industry and their income tend to be higher. So it is still an option for them.
So when you look at the houses being sold, is there a difference that you're seeing when interest rates are really low, where people were saying this was going to be contingent on a mortgage versus not? And when you look at the mortgages, are they taking out fixed rates or are these much more variable now?
People are taking fixed rates, or it actually varies. I don't see any specific tendency. As I said, we are not as much stimulated by the interest rate as more of a, what is a stock market doing. What I've noticed, the biggest difference is, yes, the market is still competitive and we see multiple offers, but it is not as much as we saw before the interest rate increase. So if before the interest rate increase, we saw 20 offers on one home, non-contingent. Today, we see 2 to 5 offers. And most of the times, contingencies are waived fully, including mortgage contingency in our market.
Oh my gosh.
Anna, it's Dom here. The reason why I'm hitchhiking is because I'm a Northern California native. I was born and raised in the Bay Area, but when I was growing up, it looked a lot different than it does right now. So please take us through what the quote unquote $1 million home looks like in San Jose, California today.
So $1 million not going to buy you much here. It will be very tough to find a single family home for $1 million. This home, for example, that we're seeing right now was sold for 1.64. This is a pretty average home, 1,300 square foot.
Oh my gosh.
It was built in 60s. Pretty standard, nothing special. It is not a luxury home. It is very modest, average family home. So yeah, $1 million probably will get you a modest town home.
How many bathrooms?
$1.7 million for 1,300 square feet. 3
Yes,
bedrooms
that's
and
right.
2 baths.
Is this the top, Anna? Can it ever go up from here? This has got to be it. I know people have been calling it top for maybe 40 years, but this has really got to be it.
Well, I have to say we still saw prices increase. So this home was sold in May. And since then, we still saw a little bit of price increase, even when the rates continue to rise.
All right, y'all. So that is insane. We're going to look at some stats right here. Now, I'm throwing up this comment because, okay, so thank you, Lisa. Real estate is, and she's all caps there. She wants us to really know, and so do I. And that's why I threw this comment up here. Markets are very local. Okay, so that's why I actually put this up here. And what I wanted to show you is what's going on in San Jose and why it is. In other words, guys, it's really important that we understand that we need to follow our own local housing markets. Now, I understand it's very hard to do that when we can't count on every realtor. We can't see all of the inventory, and everything is so different. So let me show you what's going on in San Jose according to Redfin. Now, the interesting thing here is obviously the value started plummeting when, around May of 2022, like almost every metro area, and it still plummeted. That's the black line right there. Now, the blue line is the rebound in median sales price. So it really actually plateaued in June, and it's just been plateauing. But the thing is home values went down last year. So it looks like it's up. It is up actually year over year. When we compare this to this, it's up 10%. But I think it's also one of the important things that they're leaving out is it's still off from peak. So it's shockingly, the median sales price peaked at 1.6 million. And now it's at 1.49 million. Basically, it's down 130,000. But I definitely think that areas like this with a huge amount of median sales price, you guys, I think that's going to be really, I don't think it's going to be necessarily, dictated on the stock market per se. But I definitely think that markets like that, it's heavy going to be basically on unemployment. I think unemployment is going to be a heavy role on what happens next in that housing market. Let me show you guys also what's crazy about California. And this is why I think unemployment is really going to impact San Jose. Look at the inventory, you guys. Inventory is just, the supply is so bad. It is so bad. So what do we have right now? So supply, actually it went up. That's crazy. Okay, so never mind. It did go up, but it's at 3 months actually. So why is it like, oh, okay. It redid to every metro area. That's why it was like that. I was like, wait a minute, this isn't right. Okay, here we go. Here's San Jose. So San Jose is at less than 2 months of inventory. So really, the only way that San Jose median sales price is going to collapse is the consumer, right? Once the consumer start, oh, wait a minute, maybe I shouldn't have bought a $1.3 million, 1,300 square foot house. I think that reality is going to start in. But look at this. And this is the same thing that's happening in San Diego. The fact that San Diego has no inventory, I think that we see markets like that, like a bigger dead cat bounce, a bigger recovery for median sales price because there's no inventory. But the places like Austin, Phoenix, Las Vegas, even that has a whole bunch of inventory, we don't necessarily need the consumer to go into, to get laid off and things like that. But definitely, I think that is the case in places like San Jose that have absolutely no inventory. Let me know what you guys think. Maybe I'm off here. We're going to listen to one more video, and then I'm going to go into some really cool stats with you guys. This next video is pretty intense. So let me explain this next video. This next video is basically going to go into the fact that the bank runs are not over. Regional mid-sized banks right now, a lot of danger there. Now, I'm particularly concerned about this because we know that if we have more bank runs and the Federal Reserve starts printing money to bail them out again, that the can is going to be kicked down the road again. And that's what happened in March of this year. And not only will it can, as far as recession, job loss, housing market reset, be kicked down the road, inflation is going to get worse again. And who's going to pay for the inflation? We are going to pay for the inflation. So I'm just saying we don't want necessarily, not yet anyways, we don't want bank runs. We want the prices of homes to be affordable. I'm not talking about the payment, although that's important. I'm talking about the prices. So this is a really, really good video that's going to go into the health of the small banks. A lot of people have wrote it off. They're like, oh, we're done now. But remember, we had the second, third, and fourth largest bank run in history happen this year. Oh my gosh. All right, so enjoy the video, you guys.
A look at how the Fed's rate hike path is impacting the health of regional banks. And I want to bring in Daniel Cerullo, a former Fed governor who led the central bank's regulatory reforms in the wake of the financial crisis. He's now a professor at Harvard Law School. Thank you for joining us. How concerned are you that the way things are headed, if they are headed or continuing to head up, that we are about to break something?
Well, Andrew, I distinguish there between the economy and the banks. As I've said before in your program, I am concerned that the Fed has not been forward-looking enough about the possible pass-through of the effective rate hikes that it took last year. And, with this, you never want to put too much emphasis on any one print, but, this morning's inflation news just lends further credence to those who have been saying, look, a fair bit of progress has been made. You're going to keep rates up. And we're a bit worried that when companies need to refinance, when a lot of the effect of rising interest rates comes into new lending, that the Fed will have inadvertently pushed us into a slowdown. So that's kind of the economy as a whole. With respect to
that's the economy side of this story. But let's talk also about the bank piece of it, because we just had Barry Sternlicht on. He thinks things are getting broken already.
Well, I think there are certainly risks there. I mean, look, the large portfolios of bonds and which losses have not been recognized continues to hover over the system, and particularly with some of the mid-sized regionals who might have deposit flight problems again. So I don't want to overstate things because I think there's continuing vulnerability. But, Andrew, I think the real point here is not a near-term vulnerability. I think the real point here is the ongoing business model challenge of these mid-sized banks, the banks between $50 and $250 billion. I mean, those were the ones we saw failing and in trouble in the spring for idiosyncratic reasons.
Well, so that's the question, though. What would you do about all of this? We have this still, I think, implicit guarantee around deposits. It's clearly not explicit. It's not codified in any kind of law. We didn't, when this was all tested to the extent it was, it worked. But that was not a series of banks all at the same time. How does that play out?
Well, I think here's where, so what's going on right now? I mean, the big banks were just fine in the spring, right? The biggest, the four mega banks, actually, people were moving their deposits into those banks. So the group with which I think we're most concerned is that $50 to $250 billion group. And there, I think, as I said, they're just caught in a squeeze. And it's a little hard to see how that group of banks survives in anything like present form over the next 10 years. So to me, consolidation among those banks is a one clear option for giving them some additional scale and maybe allowing them more effectively to compete with the super regionals and the mega banks. The problem, I'm sorry, I just want to say a problem here is that the antitrust division appears to be saying that it's going to look unfavorably on bank mergers generally, not just among with the biggest banks, with which I certainly agree, but even among the regionals. And that would just sort of put them in a trap then, Andrew.
That's where I was going to go with this, which is I'm sure you have folks inside the Treasury Department who may very well be aligned with your way of thinking around trying to create some transactions that gives them some ballast and enough concentration to actually be able to withstand things. And yet you're going to have this other side of the administration that has a very different view of that. Who holds the balance of power, you think, on that front?
On bank mergers, I think the antitrust division has an awful lot of weight. And here's the reason. So if the antitrust division challenges a merger in a non-regulated industry, high tech or something, the companies can choose to fight it in court immediately. When the antitrust division has negative views on a bank merger, they communicate those in advance to the bank regulatory agencies. The bank regulatory agencies, I think, are going to be reluctant to approve a merger that the antitrust division has questions about. And the agencies have lots of reasons to deny mergers, management capacities and the like. So I think effectively, the antitrust division's views will carry more weight in the banking industry.
Dan, real quick, final question, and it may be sacrilegious to even raise the issue. Do you think that the United States has too many banks? There's an argument that has been made among some that you look at the UK or you go back and look at Australia or Canada, just the approach to banking is so very different. It's much more concentrated. Now, you could also look at 2008 and say, look, it was the biggest banks that got in trouble. So the idea of consolidating all the banks, that's crazy. But there's others who say it actually would be the answer to a lot of these issues.
So, Andrew, in 1984, there are about 14,500 banks in the United States. Today, there are about 4,000. So this trend to consolidation really has been continuing and was accelerated when the restrictive branching and interstate banking laws were liberalized. And we've definitely seen that with community banks over the past 20 years or so. And I'm hoping that what's happening is that it's making the surviving community banks stronger, those that really do have a capacity to have good relationship banking. So I think when you ask the normative question, is it good or bad? I actually think the answer is the positive question. There's going to be more consolidation. The question is, will the banking agencies and the antitrust division be keeping an eye on the end game? What does the competitive landscape look like after this consolidation is complete?
Wow. Pretty amazing stuff.
you
So,
investing in?
I hope you guys got what he was saying about the consolidation that's going to happen. I mean, that's him saying, very important person, a former Fed governor, basically saying the bank runs aren't done. There's going to be a consolidation going on here. So anyways, a lot of stuff going on. So what I want to do now is I'm going to go into a special part of this video. We still get things, okay, here's the thing. And I did listen to Jeb's video, by the way. I'm probably going to, maybe respond about Jeb's video. I get emails like, oh, Jeb said this, Jeb. But he used all of the wrong data. I don't know why these people were using the wrong data. So I understand like why people don't get what's going on now. And also, I was listening to Meet Kevin's podcast yesterday with Bigger Pockets. Now, first of all, let me say, you guys hear me say this, I'm really transparent. The content creator in me, I really respect that guy, Meet Kevin. He's a huge inspiration from the content creator in me. But this is what I'm saying. In that podcast he did with Bigger Pockets, I really enjoyed it because it was like the blueprint for multi-millionaire real estate bulls, right? So I was listening to that and there's so much I don't agree with, but like, it makes me understand. There's so many levels to this game. These guys are at the top of the level. They can take big risks. When you have millions of dollars in backing, then you can chase future appreciation. If you're a consumer like me, we got to be careful for like our savings rate, the Fed continuing to print money, inflation, like these things impact us. These millionaires, it doesn't impact them. But one of the things that they said on there, and I hate that, they're asking the people that don't have these answers, but they're like, well, how's the market going to crash? Because you think it's going to crash? And I'm just like, no, answer this question, right? So I want to show you guys just a few things. We've already talked about where inventory can possibly come from many different areas. So I want to talk again about why I think the housing market is going to crash. One of the primary reasons, and I see you, Straight Drive is the guy that has like 5 or 6 troll accounts that talks to himself. But I love the guy, to be honest with you, and I really hope he sticks around because no matter what happens, we're kind of in this together. So I see you, brother. It's nice to see you, but calm down on the troll accounts for the love of God, please. But this right here, you guys, is the PE ratio. Okay. So again, this is the world view of the PE ratio. And that basically, what is the PE ratio? It's a median house price divided by median household income. And I'm about to blow your minds when I get to the last chart here, but look at this, you guys. Okay. Look at the PE ratio. Now, what do we normally want the PE ratio at? Do y'all remember? So 4 to 6, let's just say 4 to 6. Okay. We want it like 4 to 6, let's just say. Right now, the PE ratios, especially in California, look at right here, are out of control. So if you guys remember last year, look at these cities. Okay. This is number 6, 5, 8, and 11 in the world, you guys, in the world. All of these metro areas you guys see right here had year-over-year price decline in the face of no inventory. Again, every metro area you see right here, Los Angeles, San Jose, San Francisco, San Diego, all had year-over-year median sales price decline into this year, in fact, actually, into this year and last year. And it wasn't because of the lack of inventory. It was because of the unaffordability. So one of the huge things is the lack of fundamentals when we talk about the price of houses when compared to the earnings of a median household. If consumers in America cannot afford to make their housing payments, then the whole economy and sector will collapse. Why is that so hard for people to understand? But look at this, guys. Look at the number 3 right here. Number 4 is Honolulu. Number 1, surprisingly, look at number 1, Hong Kong at 18. Dang. But I think that's a population problem as well. Like there's nowhere they can build. And also that's another problem here, okay, with like Los Angeles, San Jose, San Francisco, San Diego. They're not building like they're building in Texas. So in other words, I think, again, a lot of these cities, as long as we keep the elevated interest rates, buying demand is getting exhausted. Things are changing. They're going to crash. But the more that they have inventory, the more that price decline will sustain. But again, there's just not enough inventory here. And we saw that. Okay, so again, PE ratio though. That's why do we think it's going to crash? Why do we think that okay, well, if it's not obvious, one of the reasons, one is the PE ratios is unprecedented and it's not sustainable because it's spread not to just these local markets right here. It went well past these 5 markets. It spread in the entire US, right? It hit everything. It's not just these markets. The PE ratio is bad. But another reason is this, the national payment to income ratio. This is affordability. So the other thing is like the lack of sustainability. This is affordability. The affordability is unprecedented. The lack of affordability is unprecedented. We're sitting at 38.3% of household income going to just principal and interest. When we throw taxes, when we throw insurance, especially if you're in Texas, this could be closer to 50%. And this is the average, you guys. This is the average. The payment to income ratio is going to lead the new home buyers to foreclosure. If you purchased before 2022, you probably have a low interest rate, right? And you probably have a lot of equity. But again, one of the other reasons I don't think it's sustainable is the affordability is absolutely insane. And it spreads to the entire nation, not just San Diego, not just places like that, but all over the place. I'm just saying, you guys. Here's another reason, okay? So people are like, what bubble? What bubble, right? Like, what are you talking about? What bubble? So what I want to do, guys, is let's compare the Case-Shiller Home Price Index to CPI. And let's look at the health of the consumer. So this chart helps us a few things, okay? But going back to why is the housing market going to collapse? Like, people can't fathom this. Most of them are a little bit younger kids and they've never been through anything like this before. And most of them are using their emotion and their hopes, and that's fine. Maybe they're right, but I don't think so. Because look at the equity run up. Now, real quick, the black line is CPI. Okay, you guys see that black line right there? That's CPI. The red line is home value. Okay, so first of all, let's go back and let me show you guys the 70s and 80s. And let's look at that because I really want to show you what it looks like and how the consumer is different. So everyone knows about the wealth gap, right? Everyone knows about the wealth gap. The wealth gap really starts spiraling out of control in the 70s, okay? Which means the corporations are taking the profit and they're not giving it to the consumers, and yet they still want it to prop up housing prices on our backs. Are you kidding me? Maybe they could get away with that in the 70s and 80s, but look at this, guys. You can see the start of that divide really happened in the 70s. Do y'all see that? Do y'all see where that red line started separating from the black line and then obviously into the 80s? Do you see that? But what I wanted to point out is the consumers back then, the wage growth kept up with inflation. Wage growth, right now, it's not keeping up with inflation. Back then, wage growth kept up with inflation. So even though there is this gap forming starting in the 1970s, we still made enough money. We could save enough money. Consumers can handle that. Do you see that? That's the 70s and this is the 80s. That's that when that gap started happening. Do you guys remember me talking about the 70s and 80s inflationary battle? Look at it. You can see that right there. Okay. And that was sustained. Why was it sustained? Because people made more money. Did you guys hear me? Like, people made more money. But look at it started really getting out of control once again. Wasn't there a dot-com recession or something like that? Every time they print money, they screw us. Every time they print money. Anyways, but look at it get really out of control here. Okay, this is the great financial collapse. And look at the divide. Again, people are like, oh, it crashed right here because of the loans. And it's like, okay, well, keep that thought, right? Like, what do you mean because of the loans? Like, what happened with the loans? People stopped making their payment because they couldn't afford it anymore. Why couldn't they afford it anymore? Because the payments were too high and they lost their job. Happened like this. And yet it can't happen again, they say. They don't think it's going to happen again. That's okay. That's just their points. But look at, guys, let me compare. This is the great financial collapse. Okay, look at this divide. Massive divide on like household income, consumers, and house prices. That is a huge bubble. Look at the bubble crash. Look at that. Boom, 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 boom. And look at back into a little bit more normal, right? See that? But look at what has happened today. Look at this bubble. Look at how big that's getting. Boom, 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 boom. Look at this. Look at this. Look at this. And then it just skyrockets, you guys. Just skyrockets. Look at that. And this is that little dead cat bounce. This is a sucker's rally. I think that's a sucker's rally right there. And I think people are using their emotions to justify. That's what I think. But look at Even in the 80s, it went down. So people are like, nah, it's going to just keep going up. Are you guys at it? I mean, I just don't see it. I just don't see it. The gap is worse. We are in worse shape. What? By almost not quite double, but my gosh, you guys, okay, 1,700%. This was 1,000. So about 70% worse bubble. This is not only, this form tells us a lot. Okay, this chart right here, which is an amazing chart, this shows us the size of the current bubble. And this shows us how much weaker the consumer is, because look at how far down this the CPI is. Where's my wages? If this black line, you guys, if this black line was like right here, like way closer, I'd be like, okay, home prices may sustain, because consumers can afford it, right? Because everyone got a raise. Everyone's doing well right now. But the reality is not everyone's doing well. It only looks like it's okay because they printed so much money during COVID. Why can't the bulls get it? They printed so much money during COVID. At least that's, anyways, I'm sorry, that was a little bit passionate. But again, why is the housing market going to crash, right? Why is the housing market going to crash? Let me show you something else. Let's talk about the consumers. Let's talk about refinances. Look at this. This is insane. Okay, so everyone has heard the golden handcuff lock-in effect, right? The lock-in effect, similar to the 70s and 80s, brought the popularity of assumable mortgages. Right now, people are trying to do sub-2s, but we hear all the time only 10% of homeowners have a rate over 5%. Y'all, that is changing rapidly. So this is the stats right here for cash out refinances. Let me just go into this, my opinion on cash out refinances before I go into this. First of all, I think mostly cash out refinances is horrible. Mostly, okay? I do think that for certain individuals, especially if they're investing and have an immediate use for the funds, maybe a cash out refinance is okay, like with House Hacker. But like people with House Hacker, he's like top 1%, right? Like there's another 99% of people that this isn't going to apply to. Maybe not 99%, but you guys see my point. So what we see here is basically what this is telling us is the rate change from refinance, okay? And just in case you guys don't understand, right? So the average change of interest rate for a cash out refinance right now is 2.34%. Do y'all hear me? It's 2.3. So if someone has a 5% interest rate, add 2.34% to that. That means they go from a 5% to a 7.34%. So what if they have a 4%? Because remember, 4% is really low, right? So 4% plus 2.34 is what? That's 6.25. So the people that are, and look at the surge in this. I mean, people that are cash, really, if you're going to cash out refinance, there's really two reasons, right? Like one of the reasons, which I just don't think there's a lot of people doing that, is to invest. So you would cash out refinance, either like me, invest in the stock market, business, buying another house, or even doing renovations on your own house. But the other reason, and this is what I think is going on here, is turmoil, is struggles from homeowners. And we know that homeowners are struggling because according to Zillow, 20% of the active listings for existing homes are selling because they're forced to, because they can't not afford to be a homeowner. So I think that what we see here is like, you know what, trade my interest rate, I need the cash. I think this is a cash grab we're seeing here. And that cash grab is super expensive. So although, yes, there's a golden handcuff effect for sure, and I'm just using that definition of golden handcuff, it's changing. Nothing is going to last forever. Like the people are like, it's just supply and demand. It's not consistent though. There's so many factors affecting supply. There's so many factors affecting demand. It's really frustrating that people aren't seeing through this. And again, we're talking about caution here. We're really talking about caution. Let's move on to the next thing. Take a look at this long-term market. Long-term rental market is changing drastically. In fact, apartment asking rent is already down. Deflation, not disinflation. Deflation is down 1.2% year over year. This is asking rents, keep in mind. That's asking rents. The actual rent is going to lag a little. But asking rents is down 1.2% year over year. Now, why is it important that the long-term rental market continues to deteriorate? Because if it continues to deteriorate, investors, specifically REITs, if Johnny flies on right now, let him know. Oh, there's Johnny. Johnny, here's Johnny right here. Okay, this is my man, Johnny. So me and Johnny talk. I'm like, Johnny, STRs. He's like, just send me my dollar. I'm like, no, I'm going to get inventory here. Johnny's like, you're not going to get the inventory. Next year you will, but you're a year early because you're like Michael Berry, blah, 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 blah. But he's like, I think, Travis, that we're going to get most of the inventory from REITs, real estate investment trust, because they're going to be so busy buying commercial real estate because we have a meltdown right now in commercial real estate that they're going to liquidate some of their SFR portfolios to get cash. Because why? Because cash is really hard to get right now. Okay, so when the rental market goes down, it's more likely that that will happen because the cap rates go down with the rent, right? Y'all see what I'm saying? So let's look at what rent is going on right now. Now, first of all, this is month over month national rent. Again, more so apartments. We want to see this in SFR, obviously. Now, here's Realtor.com. So Realtor.com actually has median rent year over year. They actually have it declined already. So depending on the, oh, I'm sorry. Let me remove Johnny's comment. Sorry about that. So you guys can see that it's actually already showing deflation with median rent year over year. Right here, you see that according to Realtor.com. Not all the data sets, like here's CoreLogic. CoreLogic is so, and this is what I read a lot actually, this is CoreLogic. It's so CoreLogic is not showing deflation. It's clearly showing disinflation. You see that, but it needs to go under that 0% for deflation. So look at the trend. It's heading that way. Is it there yet? Not really. Now look at this. Here's another one. Let's see here. Here's another one right here. This is from, what data set is this from? Real Page Market Analysis. So here you also see, look at the disinflation. Do you see that disinflation? Again, it needs to go negative, like it's negative right here for deflation, for negative, right? Because people are like, oh, we're handling the inflation, but the prices are still high. Well, that's not what they're talking about. Prices will stay high if we don't have deflation. I want you all to know that. But anyways, look at the rental market is in bad shape. And ask yourself a question, why is it in bad shape right now? Do you guys know why it's in bad shape right now? I mean, the supply. And not only is it in bad shape right now, literally the next 2 to 3 years, there's going to be an unprecedented amount of supply and inventory. And if we know anything about the rule of supply and demand, we know that much supply coming to the market, which will be unprecedented again, it's going to affect prices. Same thing with STRs, REITs, consumers going bankrupt or unemployment. It all leads to a surge in inventory because that's the environment we're at right now in the housing market. Is it slow? Yeah. It is slow. Was there huge home buying demand this year that made it appear like the housing market was rebounding? Yes, it did happen this year, and it did appear it was rebounding. But when we look at the historical precedences, again, where's inventory going to come from? Why is the housing market going to collapse? It's a little bit easier to see that. Now, I know it's easier for me to feel confident in what I'm saying because I've already lost everything. I've already lost this bet at one time before. So anyways, look at this article. We'll end here, and then we'll take some Q&A. So this article just came out. A few bullet points here. I like Insider. I'm not going to read this article. You guys can come back and read this if you want, but take a look at the 3 bullet points. Again, the market is softening at the very least. Once again, we'll say softening so we don't, have anyone get offended, but the U.S. housing market is starting to flash a few rays of sunshine for prospective home buyers. Finally, an article that's talking about sunshine in like a logical way. Number 2, inventory is growing. Johnny, inventory is growing. I'm groaning because of the prices. Inventory is growing at a time of year that usually sees declines. It's still possible I win that bet. It's still possible. We got other factors that's giving us inventory. And inventory, as you can see here, it's going up. Again, depending on what you're looking at. And Redfin reported that more home sellers are lowering their asking price. So prices are going down. Okay, I think that's pretty easy for us to see. Now, let me take some questions and comments that you guys threw up here. Really, really good stuff here. I want to start with Jackie. The national debt belongs to every American citizen, not any corporation, including the Fed. Do you guys understand what he's saying right here? And this is why it was so depressing, that bank bailout that happened in March, because not only is he right here, each one of those bailouts is costing us. They promised us also they were never going to do it again. And if you went through the great financial crisis, you remember that. It was through that TARP, the Toxic Asset, repayment program, TARP. So it's really horrible. Mr. Watson, it's nice to see you, sir. Always nice to see you, Mr. Watson. Paying off your mortgage early is, I think, one of the best investments, regardless of interest rate. Peace of mind over peace of theoretical math returns. I mean, he's right, man. Like, and I did a question the other day, Mr. Watson, actually yesterday, about is it your priority to be a millionaire? And it was like almost 50-50, but I'm going to tell you guys right now, my priority is not becoming a millionaire. I have no interest. It would be nice, right? It would be nice, but I have no interest in that. What I'm looking for in my life is balance, right? And I want quality time with my family. That's really important to me. So this is from FG. Commission should be a flat fee. He's talking about realtors. To be honest with you, it's probably going to be something like that. Same thing happened. Remember, I tell you guys all the time, Dodd-Frank, Wall Street Reform, and Consumer Protection Act re-regulated loan officers and drastically changed our commission. Okay, this is an important one. This is important because I think about this all the time. Like, in what condition do I think it would be safe for someone to buy? If you're the better off you are with no consumer debt, having savings, right, finding something you love, having realistic expectations, having a solid job, it all goes into play. But this is what Jess is saying. I'm taking Travis's advice, saving, paying off all revolving debt, good, and getting myself in a position to buy as soon as a good deal comes up. Yes, but Jesse, also understand, I think those are all great things, but also we want to have the realistic expectation. We want to imagine we're stuck for 10 years. We want to know that our job is solid, and we want to love the house. And then that cash flow, I think that the cash flow is important for consumers. I think that wedge or the buying under market value is important for consumers, especially because, again, the job loss is something we can't prepare for. We cannot prepare really for job loss. So understand that if I say, yeah, okay, fine, go buy a house, there's a lot of strings attached. And I'm not even representing people right now. And I get emails, and I got a few emails with the market analysis. If you guys need a market analysis in Houston, email me. Julian's helping me do those market analysis. I refuse to, I refuse to represent people still. Now look at this, guys. I did my video yesterday about how the Airbnb bans are spreading around the nation and how it's kind of like a domino effect right now, especially considering that Dallas chopped off the legs of the STR owners by not allowing them to run in residential zoning areas. So this is interesting because what this person's saying, thank you, D, he's saying that Michigan has just banned as of yesterday. Where are we going to get the inventory? I'll tell you 5 places we're going to get the inventory from, but STR is one. Okay, so here's a comment from Arnold. Jeb still says this is the best time to buy. So I was actually going to put his video in this video. I think I'll do that tomorrow and have a reaction to Jeb's video. To be honest, guys, I used to watch Jeb all the time when it was okay to cheerlead. I used to have a tremendous respect for Jeb and his production and his quality and just his presentation. But I've been really turned off by just the disrespect, just the fear of missing out, just the fear of missing out. So I'll probably do a video. And the only reason I would even do a video, I don't want to bash him. I'll be super respectful. Because he was using the wrong data. Essentially, some of the takeaways that I got is he said that for new homes, we only have 1.9 months of supply, and we need 4 to 6 million homes, new homes. So, and then I looked at the charts he was referencing. I'm like, where's he getting this info? So, and then I went to the place where he's referencing the info, and I spent like 30 minutes to try to find where he was getting the info. And then I got some other info, and it was completely wrong with what he was saying. But I understand if he really thinks we only have 1.9 months of inventory for new homes and we need 6 million for a balanced market, then I can see why he's saying what he's saying. My only concern is it's leading to the fear of missing out, right? So I'll probably go into that tomorrow. The information that was used, as far as I can tell, and I did research his data, they don't link it. Realtors don't link the data, unfortunately. So it took me some time. Anyways, I'll go into that probably tomorrow. I want to be super respectful because honestly, that guy helped me be a better person. He has no idea he's helped me be a better person. It's just, I had to stop watching it because of my own personal beliefs of what he's saying, hurting people, you see? So I had to stop listening. Man, but some of these people, it hurt me because I really was fans. Anyways, I would imagine broke real estate agents would be some of the most likely people to be over-leveraged in SFHs. He's right. I was a real estate agent when I lost my house because in a lot of people's minds, and listen to where they're getting trained from National Association of Realtors, some of the cheerleading brokers, a lot of them believe that home prices can't go down. So if they believe that home prices can't go down, then they're just going to keep buying. So when that does happen, it won't be good. I think that they will, top villain. And this is a huge problem. The fear of missing out. It's like people stop wanting to be educated about how to find a great deal. And they just wanted to buy a house because they wanted to fit the social norm. And it's really sad. And so when I see that happening from the industry professionals, I know they're biased and financially. It's just stop the fear of missing out. Charles, appreciate the super chat. This dude I'm working out, Charles. Okay, I'll probably show you some. I don't know if I'll show you pictures. I'm working out, Charles. I'm trying, man. I don't ever know if I'm going to get in your shape. But if he buys $1.7 million house, he wants a mansion, not the 1,300 square foot house that we saw in that video. It was 1,300 square feet and it was over $1 million. Question from Travis. Are we going to see year-over-year price decline again this winter? The thing is, Travis, is we already see it. That's why when I see these like straight jack, it's like, dude, okay, yeah, we get every market's different, but we already see year over year. That's why I don't even respond anymore half the time unless it's like something that hit me, because it's like, just we've been over this and you're not even paying attention. But we already have year over year price decline in many metro areas. I believe we have 3 metro areas in Texas right now with year over year price decline. Do you want to see? Do you want to pull this up? All right, let's pull this up real quick. So if you really want to see some year over year price decline, let's go into this real quick. Okay, remember, you guys got to go type in Redfin News. You can't just type in Redfin. Okay, you got to go Redfin News. You go to the data center right here. Let's see if we have some median sales price year over year decline. Let's go. I mean, obviously Austin. Okay, so if anyone says the price is only going up, like, yeah, they're going up a lot on average, but places like Austin have just got out of year over year price decline. In fact, Austin is still down. So we have that right here. This is a fact. Okay, this is a fact. This is no guessing. Okay, let's look at Dallas as well. Okay, Dallas is right there. So that's so crazy. So Dallas is right there. Let's look at San Antonio. Okay, and this is unfortunately only into the 17th. So this is not all the data. So San Antonio, holy smokes. So San Antonio is really close to that year over year. Let me look at the trajectory. Do y'all see that trajectory right there? Let's see what's going on with Boise. Okay, so there's another one. Boise has year over year price decline. Okay, so Boise is under 2021 levels of median sales price right now. You guys can see that. Boise. Let's look at Las Vegas. Let's see how well Las Vegas has rebounded. Okay, Las Vegas. Let's see. Maybe do they rebound? So again, Las Vegas year over year price decline. Okay, so everything we looked at so far, you guys know year over year price decline. Alrighty. Let's move on. Go back here. Okay, so that was some of the stuff. Trav, the last one right here. San Jose is not building single-family homes anymore. Now, we're going to end there, and I want to tell you that, like this comment right here, the reason why this is so important is because he's right. Places in California, like especially San Diego, and I went there, they don't have building like they have in Texas. For me, it's really easy to see this because I'm just so happen to be in the heart of it, right? I'm in Texas. So I have the most inventory increase than any other state for new construction, at least in my area. It feels like that. So a lot of stuff going on in different markets is my point. And really what I want to conclude, guys, is basically, here's what I want to do. Set your goals, all right? Don't get trapped on the sideline. Don't get stuck on the sideline. Don't get discouraged from people saying, oh, if you didn't buy before 2021, you're never going to. Don't let that in your head. Focus on your own goals. And also on the sidelines, whether you're on the sidelines or not, improve your purchasing power. Every day, improve your purchasing power, credit, income, and assets. And also super important, okay? Understand your local housing market. You have to understand your local housing market. I'll end you there. Oh, one other thing, actually. And if you're struggling, go on and enjoy your family. Let me show you guys, and this is where I'll end real quick because I promised someone I would show these pictures. Take a look at my family pictures. This is what I did instead of work, okay? Y'all like my photography skills? This is my family right here, y'all. That's my family right here. Look at it. Do you guys like these pictures? I love these pictures, okay? See my arms right there? So it's not as big as that one dude's, but I'm trying, okay? I'm trying. That's my family, you guys. So if you're struggling, just, man, I mean, chill, right? Just chill out a little bit maybe and love your life, I guess is what I'm trying to say. Anyways, you guys, I absolutely love you. I'll have the Redfin updated report out this evening. You guys, again, all of the trends that we want to see are happening right now, just like we thought, including price cuts, median sales price going down, supply shooting up. I mean, I'm going to have that for you this evening. And other than that, guys, really appreciate your time today. Hopefully, again, make your goals. If you're out there investing in real estate, you know I wish you luck, and I hope you